To the question of Africa needing its own credit risk agencies, the answer is a resounding yes. In a Financial Times opinion piece, Nigeria's President Bola Tinubu called for Africa's own credit rating agency, but there are also nuances that cannot be disregarded. Africa also needs stronger institutions, more investment in infrastructure and its people, as the half-life for skills, according to latest analysis, has dropped from 15 years to 5 to 7 years. That means 50% of skills learned today will have little use in, say, 7 years' time at best. It's not just population, it's more about regularly updated skills and continued investment in human capacity building. Also, governance, corruption, fiscal leakages, and accountability of leadership are still matters that can make partnering with governments problematic for investors. Risk agencies, ease of doing business ratings, and human development metrics are fallible. Biases may be unavoidable and hurtful in terms of high costs of attracting investments and debt burdens, but I dare to say losses to Africa due to leakages and policy gaps may have far higher costs. Africa would not have needed to borrow as much as it does if it had acted on its need for building better capacities to run, for example, its refineries and petrochemicals, to add value down the value chain at the time Shell was arriving on its shores a century ago. Multinationals cannot be blamed for favoring extractive activity that maintained their home country advantage in terms of value creation. Africa also presents less monolithic subsystems than, say, Europe. Its ways are far less uniform, and so much more work is needed in spotting the winners, which is what rating agencies have to do. Still, all rating agencies make mistakes, not just in Africa, and future African rating agencies should not be held to unfair standards. Today's top rating agencies cannot be absolved for their roles in several high-profile financial crises, which, despite challenges in Africa, far exceeds the much more limited damage we have seen from, say, defaults from Africa. In 2001, just weeks prior to Enron's collapse, which eliminated $75 billion in investor value and resulted in substantial losses for pension funds, rating agencies continued to classify its risk as investment grade. As a result, stakeholders remained unconcerned until it was too late. Rating agencies also assigned high ratings to mortgage-backed securities that subsequently declined significantly in value, contributing to the global financial crisis of 2007 to 2008. This crisis led to over $25 trillion in losses, the displacement of 9 million households, and substantial negative impact on GDP, resulting in the need for huge bailout funds. And it goes on. Lehman had investment grade ratings until its sudden collapse in 2008, leading to bailout support costing US taxpayers over $300 billion. Agencies also did not see the 2001 and 2019 Argentina debt crisis coming. Although ratings institutions possess certain limitations due to their imperfect assessment tools, they nonetheless offer significant value. By enhancing clarity and instilling confidence in the movement of capital worldwide, these agencies facilitate beneficial economic activity that would be less effective in their absence. Stringent credit ratings for African entities not only increase financial costs, but also create significant barriers and reinforce biases, making it more challenging for Africa to participate equitably in global trade and investments. Despite the continent's considerable resources and potential, most of its opportunities remain largely unrealized. As access to capital becomes increasingly vital in the emerging intelligent era, there is a pressing need for more accurate assessments of African risk. Still, credit risk agencies are not a piece of cake and won't be built overnight, nor even if a new African rating agency emerges tomorrow, will we see an armada of investors cured of past prejudices. Investors are highly responsive to market dynamics and recognize that if indeed current ratings truly exaggerated the cost of risk in Africa, a significantly larger volume of funds would have been allocated to the region. The underlying reality is that in less productive economies, capital deployment often lacks the efficiency that you get elsewhere. And this challenge does not originate from Western institutions, but rather from gaps within Africa that can be corrected. Currently, credible institutions are facilitating the establishment of Africa-focused risk agencies such as the African Peer Review Mechanism, APRM, and we have supporting initiatives by the African Development Bank to advance local currency bond markets. These efforts will enhance understanding of the continent's economic landscape, enable more accurate and granular assessment of growth potential and risks, and will decrease dependence on Western agencies, which, while well-intentioned, may not fully capture local realities. Analysts agree that African rating agencies will better support the growth of African financial markets, will offer more nuanced evaluations of local economies, and increase investor confidence in Africa's development. However, this move could also be misused as a shortcut, which may ultimately hinder Africa by allowing countries to sidestep important, challenging policy reforms and potentially slow the progress we are now seeing. There is also no alternative to credible agencies with robust and fact-based risk assessment processes, independence, and of course, deep analytical expertise. According to a new report by the Africa Finance Corporation, Africa is estimated at hosting over $5 trillion in gold at mine site value, including more than $1 trillion that remains undeveloped. These reserves could strengthen external buffers, stabilize currencies, and accelerate industrial growth across resource-rich economies. Stronger fiscal buffers, where they exist, need to be better factored into ratings, but we also must note that more efficient, skill-rich, and digital environments offer much lower risk than solely resource-based entities, which are also vulnerable to market volatility. Some agencies may attempt to support Africa's development without addressing the necessary groundwork. Markets will quickly detect weak credibility, leading to higher risk premium where you have strong investment environments. A better approach would be for African entities to perhaps collaborate with established risk agencies for fairer evaluations and accelerate needed reforms while building African credit risk rating agency institutions. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring you news, views, and analysis that helps to bring you up to date on the context. To other stories, UK latest CPI data just came out this morning. Headline, Consumer Price Index rose 3.0% over the year in January compared to 3.4% in December. In the policy meeting earlier this month, the Bank of England said price pressures were seen easing to around 3% in the first quarter of 2026 and closer to 2% in the second quarter. UK Shadow Chancellor Mel Stride said despite the inflation rate dropping, it still remains above target, adding that yesterday's 5.2% unemployment was a 5-year high, further evidence of lingering difficulties. The abating inflation does raise the prospect of a further interest rate cut by the Bank of England when it meets in March. Wall Street rebounded as the Nasdaq snapped a 4-day losing streak, rising 0.5%. The S&P 500 gained 0.4%, and the Dow added 0.3%, nearing its fifth highest close ever. U.S. private sector jobs also rose 10,300, beating last week's 7,800 jobs, according to the ADP employment data release. Traders await the Federal Reserve's January meeting minutes, with attention turning to Friday's Personal Consumption Expenditure Index. That's the Fed's preferred inflation gauge. Japan's exports increased by 16.8% year-on-year in January, significantly exceeding market expectations and marking the highest growth rate since November 2022, driven by strong demand from Asia and Western Europe. This growth surpassed December's increase of 5.1% and outperformed market estimates of 12%. The European Central Bank are saying that Christine Lagarde has not taken any decision regarding the end of her term. This came after media reports that Lagarde may step down as president of the ECB before her term ends in October 2027. Lagarde reportedly aims to give outgoing French President Emmanuel Macron and German Chancellor Friedrich Merz the chance to appoint a new leader for this crucial EU institution ahead of France's presidential election, which could bring unexpected developments. Warner Brothers Discovery has resumed deal talks with Paramount. Netflix offered $83 billion for Warner's streaming and studio services in December, but Paramount made a higher $108 billion bid for the whole company, which was then rejected. Paramount has since appealed to shareholders and raised its offer, though the new amount is still undisclosed. The South African Reserve Bank has announced its intention to eliminate the country's prime lending rate as early as next year, aiming to establish the main monetary policy rate as the reference point for financial contracts. In a discussion paper, the central bank explained that the prime lending rate has become primarily administrative and is now disconnected from its original function, citing its fixed margin of 350 basis points above the policy rate since 2001 as evidence. MTN Group has entered into an agreement to acquire full ownership of IHS Holding by purchasing the approximately 75% stake it does not currently hold, in a transaction that values the tower operator at roughly $6.2 billion, according to statements from both companies yesterday. As Africa's largest mobile operator, MTN will pay $8.5 per share in cash for the remaining shares. Upon completion, South Africa-based MTN will resume direct ownership of thousands of towers originally constructed and subsequently sold to IHS, marking a reversal of the industry's decade-long trend towards outsourced tower leasing. In Nigeria, where MTN operates, Communications Minister Dr. Bosun Tijani stated that the ministry is assessing development with regulatory bodies to determine the impact of this transaction. The goal is to ensure market consolidation protects consumers, investments, and sector sustainability. Asian stocks pushed higher despite the renewed artificial intelligence worries gripping global markets. Crude oil prices fluctuated after Iran touted progress in nuclear negotiations with the United States. Brent crude was under $68 per barrel in early morning trading. Well, that's it on this special edition of Global Business Insights. This is Bode or Shosami. Please do not forget to subscribe and hit the notification button. Bye-bye.